Something remarkable just happened in the silver market that most retail investors completely missed while they were distracted by the daily price action. A major silver ETF crossed $1 billion in assets under management in just over a year. The iShares Silver Trust is trading at levels we have not seen since the historic peaks. Silver miners are getting upgraded by major banks faster than analysts can update their models. And underneath all of this, there is a story about capital flight from China, its troubled banking system that is adding fuel to a fire that was already burning hot. I want to break all of this down for you because the headlines only give you part of the picture. The real story is in the details, in the data that most people do not take the time to examine, in the connections between seemingly unrelated events that actually explain why silver is behaving the way it is. And more importantly, I want to show you what the technical indicators are saying about whether this rally has legs or whether we are approaching the kind of conditions that have historically preceded sharp corrections. Here's what we are going to cover. First, I'm going to walk you through what is happening with silver ETFs and why the asset growth numbers matter more than you might think. Then we are going to dig into the China story because capital flight from zombie banks is not just a sensational headline. It is a fundamental shift in how Asian wealth is being allocated. After that, I want to break down the technical picture on SLV because the indicators are flashing signals that experienced traders pay very close attention to. Then we will look at what is happening with silver miners and why analysts are rushing to upgrade their price targets. And at the end, I'm going to give you historical context that will help you understand where we are in this cycle and how to think about positioning. Let me start with the ETF story because this is where you can see institutional and retail money flows in real time. The Sprott Silver Miners and Physical Silver ETF just surpassed $1 billion in assets under management. They achieved this milestone in just over a year. Think about what that means for a moment. $1 billion flowed into a single silver-focused investment vehicle in roughly 12 months. That is not noise. That is a trend. When ETFs accumulate assets at that pace, it tells you something about demand that you cannot see in the spot price alone. ETF inflows represent actual capital being committed to the sector. People are not just speculating on silver through futures or options. They're buying and holding through vehicles designed for longer-term exposure. The Sprott product in particular is interesting because it combines exposure to physical silver with exposure to silver mining companies. That dual approach gives investors both the commodity itself and the operational leverage that miners provide. But the bigger story is what is happening with SLV, the iShares Silver Trust. This is the most widely traded silver ETF in the world. It holds physical bullion in vaults and tracks the price of silver directly. And right now, SLV is trading just shy of its all-time high. The ETF has gained over 55% on a year-to-date basis, 55% in less than a month. That is the kind of return people usually hope for over multiple years, and it has happened in weeks. The surge in SLV reflects the broader rush into precious metals that we have been tracking on this channel. Investors are seeking hard assets amid mounting global risks. The easy trade of the past decade, buying technology stocks and riding the wave higher, no longer feels easy. Valuations are stretched. Geopolitical uncertainty is elevated. And the safe assumptions that guided investment decisions for years are being questioned. In that environment, silver becomes attractive for reasons that go beyond just price appreciation. It represents something tangible in a world of increasingly intangible assets. It exists outside the banking system. It does not depend on any government or central bank for its value. And for investors who are worried about what comes next, those characteristics matter. Now let me talk about the China story because this is adding a dimension to the silver rally that most Western analysts are not adequately addressing. Reports have emerged about capital flight from China's troubled zombie banks. These are financial institutions that are technically solvent on paper, but are carrying hidden losses that make their actual condition much more precarious than their balance sheets suggest. When savers in China start to worry about the health of their banks, they look for alternatives. Some move money into real estate, although that sector has its own massive problems right now. Some try to move money offshore, although capital controls make that increasingly difficult. And some turn to hard assets like gold and silver that can store value outside the banking system entirely. This capital flight is not theoretical. It is showing up in the data. Chinese premiums for silver have been elevated. Demand for physical metal in Asia has been intense. And the price action in silver has reflected buying pressure that seems to be coming from outside the traditional Western institutional channels. The zombie bank situation is a slow-motion crisis that has been building for years. Chinese banks have extended enormous amounts of credit to property developers, local governments, and state-owned enterprises. Much of that lending was done at the direction of the government to support economic growth targets, but loans made for political reasons do not always get repaid. And the losses from those loans are now accumulating in ways that threaten the stability of institutions that Chinese savers depend on. When you understand this backdrop, the rush into silver makes more sense. It is not just speculation or momentum trading. It is a defensive move by people who are worried about the safety of their deposits. They are converting paper claims on troubled banks into physical metal that cannot be devalued by a bank failure or a government intervention. At the same time, geopolitical tensions are adding to the safe haven bid. Washington and Beijing are sparring over tariffs again. Trade threats are escalating. Canada is caught in the middle of disputes that could reshape North American commerce. Every headline that suggests the global trading order is becoming more unstable reinforces the case for owning assets that transcend national boundaries and political conflicts. Silver has a long history as both money and an industrial metal. That dual role is unique in the commodity world. Gold is primarily a monetary asset. Copper is primarily an industrial commodity. Silver sits in both camps. It gets used in solar panels, electronics, and medical devices, but it also serves as a store of value and a medium of exchange. That dual nature means silver can benefit when investors seek safety and when industrial demand is strong. Right now, both of those factors are in play. Let me shift to the technical picture because this is where you can see the internal dynamics of the rally. SLV is trading 30.7% above its 20-day simple moving average. That is an enormous gap between price and the short-term trend. In normal market conditions, you almost never see that kind of extension. It indicates that price has moved so fast that it has gotten well ahead of the underlying trend. Even more striking, SLV is trading 93.4% above its 100-day simple moving average. Let that number sink in. The ETF is nearly double its level from just a few months ago. That kind of performance is extraordinary. But it also creates conditions where mean reversion becomes increasingly likely. Over the past 12 months, shares have increased 271.81%. That is not a typo. SLV has nearly quadrupled in a year. The shares are currently positioned much closer to their 52-week highs than lows, which tells you the trend has been decisively upward. But here's where the warning signs appear. The RSI, which stands for Relative Strength Index, is at 80.99. Any reading above 70 is considered overbought territory. A reading above 80 is extremely overbought. It indicates that buying pressure has been so intense that the market has likely gotten ahead of itself. Meanwhile, the MACD is above its signal line, which is a bullish indicator. So you have a situation where momentum is still positive, but the market is extremely extended. The combination of overbought RSI and bullish MACD suggests that while the trend is intact, the risk of a near-term correction has increased substantially. I want to be very clear about what overbought means and what it does not mean. Overbought does not mean the market is about to crash. Markets can stay overbought for extended periods during powerful trends. Some of the biggest gains in any rally come after conditions become overbought, as momentum carries price far beyond what conservative analysts expect. But overbought does mean that the risk-reward for new positions is less favorable than it was before the extension. If you bought SLV a month ago, you are sitting on massive gains, and the overbought condition is not a problem for you. You can hold through any correction because your cost basis is so much lower. But if you are thinking about buying now at all-time highs, with RSI above 80, you need to understand that you are entering at a point where pullbacks become more likely. The key resistance level identified by analysts is $106.70. If SLV can push through that level with conviction, it suggests the rally has more room to run despite the overbought conditions. But if price stalls at that resistance and starts to roll over, you could see a meaningful pullback as overbought conditions unwind. Now let me talk about the miners, because this is where you get leverage to the silver price. When silver rises, mining companies tend to rise faster because their costs are relatively fixed, while their revenue scales with the metal price. A silver miner with costs of $20 per ounce makes very different profits at $50 silver versus $100 silver. That profit sensitivity is why mining stocks often outperform the metal during bull markets. BMO Capital Markets just raised their price target on Aya Gold and silver to 33 Canadian dollars while maintaining an outperform rating. The upgrade came after the company shared a stronger outlook for its Morocco operations. Aya expects its Zgounder mine to produce between 5.2 and 5.8 million ounces of silver in the current year. That production guidance essentially matched BMO's top-end view, giving analysts confidence that management can deliver. The company guided cash costs of about $21.50 per ounce. That is slightly above what BMO had estimated, but close enough to support the production story. In a market where silver is trading above $100, costs of $21.50 leave enormous margin. That margin is what gets analysts excited. BMO said their higher target reflects model updates and valuation multiple adjustments, helped by a supportive silver price backdrop. They also pointed to Boumadine, where processing historic stockpiles could add roughly 1 million silver equivalent ounces to production. That additional production from existing stockpiles is essentially found money. It requires minimal new investment and contributes to near-term cash flow. The analyst commentary captures something important about how mining stocks work. Operational delivery is the new catalyst. Silver miners often trade with the metal, but detailed guidance can shift focus to execution. Investors want to see that companies can actually produce the ounces they promise at the costs they guide. When management provides a visible plan with specific numbers, it can compress the show-me discount that investors apply to development stage companies. But here's the nuance that every mining investor needs to understand. More ounces is only half the story. Mining is a margin business. Higher volumes do not help if unit costs rise faster than prices. Aya's cash cost guidance is a reminder that labor, energy, and processing constraints can eat into returns across the sector. Even in a strong silver price environment, a miner that cannot control costs will underperform. That is why operational improvements and resource development matter so much. They are the difference between a growth narrative and durable cash flow. Anyone can promise production growth. Delivering that growth profitably is much harder. The broader mining sector is seeing similar dynamics. Analysts are raising price targets across the board as they update their models for higher silver prices. Companies that seemed expensive a few months ago now look cheap if you assume silver stays anywhere near current levels. But those valuations depend on silver staying elevated. If the metal corrects sharply, mining stocks will correct even more sharply due to that same leverage that makes them attractive on the upside. Let me now give you some historical context because I think it is important to understand where we are relative to previous cycles. The SLV surge matters for long-term investors, but so do the lessons from history. Past spikes in silver, such as the Hunt brothers squeeze in 1980 and the post-financial crisis surge in 2011, were followed by steep reversals. In 1980, silver briefly touched $50 per ounce as the Hunt brothers attempted to corner the market. That price would be well over $100 in today's money. But the spike was followed by a crash that took silver down over 80%. Investors who bought at the top spent decades underwater. In 2011, silver surged to nearly $50 again in the aftermath of the financial crisis. That rally was driven by quantitative easing, dollar concerns, and retail enthusiasm that sounds familiar to today's environment. But it was followed by a grinding bear market that lasted years. Silver did not bottom until it had given up most of its gains. I'm not saying history will repeat exactly. Every cycle is different, and the current environment has unique characteristics that previous cycles did not have. Industrial demand from solar and electric vehicles is structurally higher than in past decades. Central bank credibility concerns are more widespread, and the global monetary system faces challenges that did not exist in 1980 or 2011. But the lesson from history is that extreme moves in either direction tend to be followed by reversions. Markets that go parabolic do not stay parabolic forever. The gains that feel inevitable today can evaporate quickly when sentiment shifts. This is not a reason to panic sell if you are already positioned. It is a reason to be thoughtful about risk management. It is a reason to have a plan for taking profits at some point. And it is a reason to avoid chasing the market with your entire position when prices are already extended and indicators are flashing overbought warnings. Let me address the Federal Reserve situation because this is adding another layer of uncertainty to an already complex picture. Investors face the prospect of another federal government shutdown at month end. That kind of political dysfunction does not inspire confidence in the stability of American institutions. At the same time, the upcoming Fed meeting is clouded by political pressure on Fed Chair Jerome Powell. The independence of the Federal Reserve is one of the foundations of dollar credibility. If markets start to believe that monetary policy will be driven by political considerations rather than economic analysis, it undermines trust in the entire system. And when trust in the dollar-based financial system erodes, hard assets become more attractive. With policy uncertainty high and risk assets already stretched, some traders are rotating into SLV as a perceived safer parking spot for capital. That is a remarkable statement when you think about it. Silver, one of the most volatile commodities in the world, is being treated as a safe haven. That tells you how uncertain the environment has become. The Fed decision itself is expected to keep rates unchanged, but the forward guidance, the signals about what comes next, will be scrutinized intensely. Any hint of dovishness could accelerate the rally in precious metals. Any hint of hawkishness could trigger profit-taking. The uncertainty itself is keeping traders on edge. Now let me talk about how to think about all of this if you are an investor trying to make sense of the situation. The first principle is to separate the long-term story from the short-term conditions. The long-term story for silver remains compelling. Industrial demand is growing structurally. Monetary uncertainty is not going away. Central bank credibility concerns are spreading. These factors argue for silver having a place in a diversified portfolio over multi-year time horizons. But the short-term conditions are extended. Prices have moved a lot in a short time. Technical indicators are flashing overbought. The risk of a correction is elevated even if the long-term trend remains intact. How you reconcile these two realities depends on your time horizon and your existing positioning. If you have been holding silver and silver-related investments for months or years, you have substantial gains, and the overbought conditions are not a major concern for you. You can afford to hold through volatility because your cost basis is so much lower than current prices. The question for you is whether to take some profits to lock in gains or whether to continue holding for potentially higher prices. If you are new to the market and thinking about establishing a position, the calculus is different. Buying at all-time highs with overbought indicators is a high-risk proposition. You might be right, and prices might continue higher. But you might also be buying just before a correction that tests your conviction and your patience. One approach for new investors is to wait for a pullback before establishing a position. The risk with this approach is that the pullback never comes and you miss the move entirely. Markets can stay overbought longer than you expect, and waiting for perfect entry points often means never entering at all. Another approach is to scale in gradually rather than committing your entire position at once. Buy a small amount now to establish exposure. If prices continue higher, you participate in the gains. If prices pull back, you have dry powder to add at better levels. This approach gives up some potential upside in exchange for reduced risk and better average prices if volatility arrives. What you should not do is chase vertical moves with your entire position and then panic sell when the inevitable pullback arrives. That is how wealth gets destroyed. The emotional whipsaw of FOMO buying, followed by fear selling, is the market's favorite way to transfer money from retail investors to more disciplined participants. Let me also address the relationship between physical silver, ETFs like SLV, and mining stocks. These are different ways to gain exposure to the same underlying theme, but they behave differently and have different risk profiles. Physical silver is the purest form of exposure. You own the metal directly, there is no counterparty risk, but physical has friction. You pay premiums when you buy and accept discounts when you sell. Storage and insurance add costs, and physical is not suitable for short-term trading due to those frictions. ETFs like SLV provide cleaner access to price movements. The spreads are tighter. Entry and exit are easy. But you are trusting a counterparty. You own shares in a trust that owns metal, not the metal itself. For most investors in most situations, that distinction does not matter. But in a true systemic crisis, it could matter a lot. Mining stocks provide leverage to the silver price, but add company-specific risks. A miner can underperform even if silver goes up if they have operational problems, cost overruns, or management issues. Diversifying across multiple miners reduces this company-specific risk, but does not eliminate it. The leverage works in both directions too. When silver falls, miners typically fall harder. Understanding these differences helps you construct a portfolio that matches your goals and your risk tolerance. Some investors prefer a core position in physical supplemented by tactical positions in ETFs or miners. Others prefer the convenience and liquidity of ETFs for their entire precious metals allocation. There is no single right answer. The right answer is the one that lets you sleep at night and stick with your strategy through volatility. Let me bring this back to the big picture, because I want you to leave this video with a clear framework for thinking about what is happening. Silver is in the middle of a powerful rally driven by multiple reinforcing factors: safe haven demand amid global uncertainty, capital flight from troubled Chinese banks, industrial demand from renewable energy and technology, and momentum that feeds on itself as rising prices attract more buyers who push prices higher still. The ETF flows confirm that real capital is being committed to the sector. The mining stock upgrades show that analysts are revising their models higher. The price action shows that demand is overwhelming available supply at lower prices. All of these signals point in the same direction, but the technical indicators show that the market has become extremely extended. RSI above 80, price nearly double its 100-day average, 271% gains in a year. These are conditions that have historically preceded corrections even in the context of larger bull markets. The intelligent response to this situation is not to predict exactly what happens next. Predictions are entertainment. They make you feel like you know something, but they rarely improve your outcomes. The intelligent response is to position yourself so that you can benefit from continued strength while protecting yourself if a correction arrives. That means sizing your positions appropriately. If a 30% correction in silver would devastate your finances or your emotional well-being, you're too big. Reduce to a size where even severe volatility would be manageable. That means having a plan for taking profits. Not necessarily selling everything, but having levels at which you would reduce exposure to lock in gains. Too many investors ride winning positions all the way up and all the way back down because they never have a plan for the exit. That means continuing to pay attention to the data rather than getting swept up in narratives. The China story is compelling. The ETF flows are impressive. But markets can turn quickly, and the investors who survive are the ones who adapt to changing conditions rather than clinging to yesterday's thesis. If you made it this far, hit that subscribe button so you do not miss future updates. I read the comments, and I want to hear what you think about where silver goes from here. Are you adding to positions at these levels? Are you taking profits? Are you waiting for a pullback? And as always, the necessary disclaimer. Everything in this video is my perspective shared for educational purposes only. I'm not your financial advisor. I do not know your situation. Nothing here constitutes financial advice. I'm not telling you to buy or sell anything. Think for yourself. Do your own research. Consult with professionals who know your circumstances to make decisions you can live with regardless of what the market does next. Stay curious, stay disciplined, and I will see you in the next one.